Trading psychology is all about emotional and mental states that affect traders' decision-making processes. Emotions, attitudes, and biases that affect a trader's behavior and performance fall within this domain. These psychological factors can significantly impact how traders handle risk, deal with losses, and operate during the highs and lows of market cycles. Here's a quick outline of what we'll cover in this tutorial. First, we'll start with emotional triggers in trading. Then, we'll dive into some common psychological pitfalls that impact trading behavior. And finally, we'll discuss how traders can learn strategies to avoid emotional trading. We've added thumbnails in the video description, so if you'd like to jump to a specific section, feel free to use those timestamps. Okay, let's start our discussion with emotional triggers in trading. Greed and fear are two powerful emotions that often surface during trading. They can seriously impact risk-taking by distorting an emotional trader's perception of the true probability of events. Let's suppose a stock would yield stellar returns if multiple events occurred simultaneously. The chances of that happening might be very slim. But a greedy trader might exaggerate those chances and heavily invest in that stock, rather than choosing other solid stocks that yield steady and good returns. The reverse is true as well. A fearful trader may avoid strong stocks altogether if he or she overestimates the likelihood of an event that could send those stocks plummeting. The important role played by fear and greed in shaping trading behavior is recognized by both investors and the financial media. One popular tool to measure this is CNN's Fear and Greed Index, which is based on 7 indicators, like market momentum, stock price strength, and breadth. The level of the index gives us a quick snapshot of the market's current mood. Traders and investors need to stay cautious about letting fear and greed take control of their decision-making. As Warren Buffett famously put it, "Be fearful when others are greedy, and greedy when others are fearful." Pride and regret, just like greed and fear, can significantly influence our trading behavior. Take pride, for example. When a trading strategy works out well, we feel proud of our success. This pride might lead us to share our achievements with others, or even show off in some cases. But here's the catch. These feelings can push us towards suboptimal decisions. Imagine closing a profitable position too early, just so we can rush off to celebrate and share the win. On the flip side, there's regret, an emotion that often arises when trades go south and losses pile up. Regret is especially powerful, often overshadowing pride. To avoid experiencing regret, we might make impulsive decisions, leading to what's known as regret avoidance. This tendency can steer us toward poor trading choices, which we'll delve into further later in the video. For beginners, trading can be an intense and nerve-wracking experience. Throughout a market cycle, traders often find themselves riding a roller coaster of emotions, ranging from euphoria at market highs to despondency during downturns. In fact, emotional traders can experience up to 14 distinct emotions in just one market cycle, as shown in this image. Alright, let's move on to exploring some common psychological pitfalls in trading that are driven by emotions. One of the most common trading behaviors that can negatively impact performance is the disposition effect. This refers to investors' tendency to hold on to losing stocks while selling winning stocks too quickly, where losing and winning are defined relative to the purchase price. Research shows that emotions like pride and regret play a key role in driving this behavior. Selling a stock at a gain provides traders with a sense of pride. It's an opportunity to celebrate their success and perhaps even boast about their smart investment decision to colleagues or friends. This emotional reward often pushes traders to sell their winning positions prematurely instead of letting them grow further. On the flip side, selling a stock at a loss triggers feelings of regret and discomfort. The trader may feel embarrassed about their decision to buy the stock and struggle with admitting losses to others. To avoid this pain, they often hold on to losing stocks in the hope of a recovery that might never come. Emotions can also give rise to revenge trading. This occurs when traders, driven by frustration over previous losses, initiate impulsive trades that deviate from their strategy in an attempt to quickly recover what they've lost. Unfortunately, these hastily made decisions often result in even greater losses as they lack careful planning and analysis. Revenge trading becomes particularly dangerous when a trader adopts a gambling mindset, desperately chasing earlier losses. This is a textbook example of emotional trading, driven by the desire to avoid the regret of accepting losses. Ironically, such impulsive reactions tend to worsen the situation as the trader loses focus and strays further from their strategy. A trader experiences analysis paralysis when they become unable to execute trades due to overthinking all the what-if scenarios. While thorough research is essential for developing a sound trading strategy, overthinking can cause traders to miss valuable opportunities. At the heart of analysis paralysis lies fear and similar emotions. Trading inherently involves risk, making it a challenging profession for those who struggle with uncertainty. To succeed, traders must have a robust risk management system in place and carefully evaluate their decisions. However, once the necessary groundwork is done, hesitation driven by fear must be overcome. Controlling fear is crucial to avoid missing out on good trading opportunities. Trading requires the courage to act when the time is right, even in the face of uncertainty. So far, we've explored how trading psychology influences trading behavior. In the final part of this video, we'll share practical tips to help traders, especially beginners, avoid emotional trading and make more rational decisions. Most of us have a natural dislike for risk and expect rewards for taking it on. However, the level of risk aversion varies from trader to trader. Some are more willing to embrace risk than others. As a trader, it's crucial to stay within your personal risk comfort zone. Doing so helps you avoid being overwhelmed by your emotions during periods of market volatility. In general, be clear about your risk appetite. Even investment companies prioritize assessing their clients' risk tolerance before recommending products. To help you gauge your own, we've included links to example questionnaires in the video description. Another effective way to avoid emotional trading is by practicing with a demo account before risking real money. This allows you to gain valuable experience in a risk-free environment, helping you build confidence without incurring financial losses. For beginners, it's especially important to grasp the mechanics of trading, such as placing trade orders, selecting the right order types, and understanding the risks associated with different securities, for example, large caps versus small caps or stocks versus bonds. Fortunately, many digital platforms offer trading simulators and demo accounts to help you practice. We've included a list of some options in the video description. Success in trading rarely comes from random decision-making. One of the hallmarks of successful traders is their ability to create well-thought-out trading plans, review them regularly, and make adjustments as needed. A solid plan simplifies the trading process, establishes a routine, and keeps the trader focused. Importantly, a trading plan also acts as a safeguard against emotional decision-making, especially during volatile market periods. By committing to the plan, traders are less likely to let emotions override rational thinking. It becomes a tool for self-discipline. An effective trading plan should, among other things, align with the trader's risk tolerance. This helps determine how to allocate funds across various asset classes or securities. Additionally, it should outline clear trading strategies, specifying when to take profits and when to cut losses, ensuring all trading decisions are grounded in logic rather than impulse. One of the most valuable learning tools for any trader is the objective evaluation of past performance. Instead of focusing on boasting about past profits, some of which may simply be due to luck, assess whether a particular strategy has consistently led to success. Similarly, rather than dwelling on regret over losses, identify patterns in your reasoning that might have led you to invest in underperforming stocks. This objective approach helps you move past emotions like pride and regret, enabling you to focus on the strategies and actions that truly work. In this regard, maintaining a trading journal can be incredibly beneficial. If daily entries feel overwhelming, aim for at least weekly summaries. Use your journal as a tool for thoughtful reflection on your trading activity. Periodically revisiting older entries can provide valuable insights, reminding you of what worked, what didn't, and how you can improve. Trading psychology plays a crucial role in shaping a trader's success, and understanding how emotions influence your decisions is the first step toward becoming a more disciplined and confident trader. If you found this video helpful, don't forget to like, share, and subscribe for more insights into trading strategies and financial concepts. Also, let us know in the comments, what's the biggest psychological challenge you've faced while trading? Check out the video description for additional resources, including the links we mentioned, and stay tuned for our next tutorial. Until then, trade smart and stay focused.